A shift in the tide, the Fed cuts rates. The Federal Reserve, America's central bank, has made a significant move. After a series of interest rate hikes, they have announced a rate cut. This is the first reduction in 4 years, signaling a change in the financial landscape. For investors, this move brings both opportunities and challenges. Understanding the implications of this rate cut is crucial for making informed financial decisions. The Fed aims to strike a balance, fostering economic growth while keeping inflation in check. The rate cut is a tool to stimulate borrowing and spending, providing a boost to the economy. This reversal suggests a shift in their assessment of the economy's health. Investors are closely watching for signals of future rate cuts and their potential impact. The Fed's actions have a ripple effect throughout the financial system, influencing borrowing costs for individuals and businesses. Understanding how this rate cut affects your personal finances is essential for navigating the changing economic environment. Breathing room for borrowers, mortgages, auto loans, and credit cards. The Fed's rate cut offers a welcome reprieve for borrowers. Lower interest rates translate into reduced borrowing costs, making loans more affordable. This is particularly significant for those looking to purchase a home, buy a car, or manage credit card debt. For prospective home buyers, the rate cut could provide an opportunity to secure a mortgage at a lower interest rate. Auto loans are also influenced by the Fed's actions. Lower interest rates make car purchases more appealing, potentially boosting sales in the automotive industry. Consumers may find themselves with more favorable financing options, allowing them to afford newer or higher-end vehicles. Credit card holders can also benefit from the rate cut, albeit indirectly. While credit card interest rates are not directly tied to the Fed's benchmark rate, they tend to move in the same direction. Deciphering the Fed's decision, economic signals, and Chairman's remarks. The Fed's decision to cut rates did not come out of the blue. It was a calculated move based on a careful analysis of economic data and prevailing market conditions. One crucial factor was the persistent threat of inflation. While inflation has shown signs of moderating, it remains above the Fed's target range. Another concern was the slowing global economic growth. Trade tensions and geopolitical uncertainties have weighed on global economic activity. The Fed's rate cut can be interpreted as a move to support the domestic economy amidst these global headwinds. In his statement following the rate cut announcement, Fed Chair Jerome Powell emphasized that the Fed is committed to using its tools to sustain the economic expansion and achieve its dual mandate of maximum employment and price stability. The saver's dilemma: navigating lower interest rates. While borrowers may rejoice at the prospect of lower interest rates, savers face a different reality. Lower rates translate into lower returns on savings accounts, certificates of deposit, CDs, and other interest-bearing investments. In a low-interest rate environment, savers may need to explore alternative investment options to maintain their purchasing power. This could include investing in dividend-paying stocks, bonds with higher yields, or real estate. One strategy for savers is to consider laddering their CDs. This involves investing in CDs with varying maturity dates, allowing them to take advantage of potentially higher rates in the future, while still having access to some of their funds. It's also crucial for savers to minimize fees and expenses associated with their investments. Shopping around for the best rates and considering low-cost index funds can make a difference over the long term. Section 5. Crystal ball gazing expert predictions on future rate cuts. The Fed's recent rate cut has sparked intense speculation about the future path of monetary policy. Market analysts and economists are closely scrutinizing economic data and parsing the Fed's statements for clues about the likelihood of further rate cuts. Some experts believe that the Fed is likely to remain accommodative, potentially cutting rates again if economic growth falters or inflation remains subdued. Others are more cautious, suggesting that the Fed may adopt a wait-and-see approach. They argue that the economy remains relatively strong, and that further rate cuts could fuel asset bubbles or lead to unintended consequences. The Fed's own projections, known as the dot plot, indicate a division among policymakers. While some officials see the need for additional rate cuts, others prefer to keep rates on hold for the time being. The future path of interest rates remains uncertain and will depend on a complex interplay of economic forces. Section 6. Charting your financial course advice for consumers. Navigating the ever-changing financial landscape can seem daunting, especially during times of uncertainty. However, by adopting a proactive and informed approach, consumers can position themselves to weather any storm and achieve their financial goals. First and foremost, it's essential to have a well-defined budget. Tracking income and expenses allows individuals to identify areas where they can save and make the most of their money. This is particularly important in a low-interest rate environment where every dollar counts. Next, consider your debt situation. If you have high-interest debt, such as credit card balances, prioritize paying them down. The rate cut may offer some relief, but it's always prudent to reduce debt and improve your credit score. For those with savings, explore different investment options to maximize returns. Consult with a financial advisor to determine the best strategy for your individual needs and risk tolerance. Section 7, the housing market conundrum, a deeper dive. The Fed's rate cut has injected a dose of uncertainty into the housing market. While lower mortgage rates typically stimulate demand, the overall impact is nuanced and depends on a confluence of factors. On the one hand, lower mortgage rates make homeownership more affordable for a wider pool of buyers. This can lead to increased demand, potentially driving up home prices. For existing homeowners, lower rates can present an opportunity to refinance their mortgages and reduce their monthly payments. On the other hand, the housing market is also influenced by inventory levels, job growth, wage growth, and consumer confidence. If inventory remains tight, even with lower rates, home prices may continue to rise, making it challenging for some buyers to enter the market. The housing market is complex and subject to various economic forces. Section 8, riding the auto loan wave, navigating new car purchases. The Fed's rate cut has created a favorable environment for car buyers. Lower interest rates translate into lower monthly payments on auto loans, making new car purchases more appealing. If you're in the market for a new vehicle, now may be an opportune time to explore your financing options. With lower rates, you may be able to afford a more expensive car, or opt for a shorter loan term, saving money on interest payments over the life of the loan. However, it's crucial to shop around for the best auto loan rates and compare offers from multiple lenders. Determine a realistic budget based on your income, expenses, and down payment amount. Consider the total cost of ownership, including insurance, maintenance, and fuel costs, before making a decision. The auto industry often responds to lower interest rates with incentives and promotions. Section 9, credit card. Caution, managing debt in a low-rate environment. While the Fed's rate cut may indirectly lead to lower credit card interest rates, it's essential to approach credit card debt with caution. Lower rates should not be misconstrued as a license to overspend or accumulate unnecessary debt. If you carry a balance on your credit cards, prioritize paying it down as quickly as possible. Even small reductions in your principal balance can save you significant amounts of money in interest charges over time. Consider transferring your balance to a credit card with a lower interest rate. Avoid the temptation to make only the minimum payment. Section 10. The global ripple effect. International implications of the Fed's decision. The Fed's rate cut sends ripples throughout the global financial system, impacting economies and markets worldwide. Understanding the international implications of this decision is crucial for investors and businesses with global exposure. One significant effect is the weakening of the US dollar. Lower interest rates make the dollar less attractive to foreign investors seeking higher returns. A weaker dollar can make US exports more competitive but can also lead to higher prices for imported goods. Emerging market economies in particular are closely watching the Fed's moves. These economies are often reliant on foreign capital and can be vulnerable to sudden shifts in investor sentiment. The Fed's decision also influences the actions of other central banks around the world. Section 11. Preparing for the future financial strategies in uncertain times. In an era of economic uncertainty, it's more important than ever to have a sound financial plan and be prepared for any eventuality. By adopting a proactive and adaptable approach, individuals can navigate the challenges and capitalize on the opportunities that lie ahead. Start by reviewing your financial goals and assess whether they are still realistic given the current economic climate. If necessary, adjust your savings targets, investment strategies, or retirement plans accordingly. Diversification remains a cornerstone of prudent investing. Avoid putting all your eggs in one basket and instead spread your investments across different asset classes. Consider working with a financial advisor to create a personalized financial plan tailored to your specific circumstances and goals. A financial advisor can provide objective guidance, help you navigate complex financial products, and keep you on track to achieve your objectives. Knowledge is power, and staying informed empowers you to make smarter financial decisions.